All right, let's talk about it. Mutual funds versus ETFs. You hear these terms thrown around all the time, right? But what's the real difference? And more importantly, which one is actually the right choice for your money? Well, in the next few minutes, we're gonna break it all down, nice and simple, so you can make a smart decision.
Okay, to get our heads around this, let's start with a super simple idea. Picture yourself in a giant fruit market. You want apples, oranges, bananas, maybe some berries. Buying every single one of those separately, it's a ton of work. But what if you could just buy one pre-made fruit basket that has a little bit of everything? Well, in the world of investing, that basket is called a fund. It's a genius way to buy a whole bunch of different investments all at once. So both mutual funds and ETFs are basically these investment fruit baskets. They both give you that instant variety, that instant diversification, but, and this is a big but, they are put together and sold in totally different ways. Which leads us to the big question we're here to answer today. Which of these baskets is the right one for you?
So, here's the plan for how we're gonna tackle this. We'll start with that fruit basket idea. Then, we'll meet the professional chef behind mutual funds and the index tracker that powers ETFs. After that, we'll put them head-to-head in a direct comparison. We'll figure out if you're a guided tour or a DIY kind of investor. And finally, we'll talk about the real goal that both of these tools help you reach. Sound good? Let's dive in. Okay, first up, mutual funds. And the best way to think about these, imagine you're hiring a personal, professional chef. You give them the money, those are the ingredients, and they go to work creating a unique meal, or, in this case, a unique investment portfolio just for you.
And that's pretty much spot on. A mutual fund is just this giant pot of money collected from thousands, sometimes millions of investors. Then, a professional fund manager takes all that cash and actively invests it for you. They're buying and selling stocks, bonds, whatever. Their entire job is to make those tough decisions so you don't have to.
So the big thing to remember here is that they are actively managed. You've got a pro at the wheel trying to pick the winners and beat the market. Now here's a weird quirk. You can only buy or sell a mutual fund once a day at a price that gets calculated after the stock market closes. And because you're paying for that professional chef and their whole team, yeah, they typically come with higher fees. All right, so that's the chef. Now let's check out the other kind of basket. The ETF, or exchange-traded fund. Now, for mutual fund is a creative chef, an ETF is more like a very precise cook who's following a famous recipe down to the letter. So, an ETF is also a basket of investments, but here's the game changer. ETFs trade on a stock exchange all day long, just like a single share of a company like Apple or Microsoft. You can buy them, you can sell them at any minute the market is open. Total flexibility. What this means for you are a few huge things. First, that flexibility we talked about, you can trade them anytime. And second, lower costs. Now, why are they cheaper? Well, it's because most ETFs are passive. They aren't trying to be clever and beat the market. They're just designed to perfectly copy or track a market index, like the famous S&P 500. They're following a recipe, so you don't need to pay for a creative genius. Okay, so we've met our two contenders. Now it's time for the main event, the head-to-head comparison. Let's really put them side by side and dig into what separates them. First round, trading flexibility. And this is a massive difference, you guys. With a mutual fund, it's kind of old school. You put in your order, and you just have to wait until the end of the day to get your price. With an ETF, it's live. You see a price you like at 10:30 in the morning? Boom. You can buy it or sell it right then and there. You're in control. Next up, management style. This really gets back to that whole chef versus recipe thing, right? The mutual fund manager is the active chef, constantly making judgment calls, trying to outsmart the market. The ETF manager, they're just following the recipe. Their only job is to match an index perfectly. And here's a little secret. Decades of data show that it is incredibly hard for even the smartest chefs to consistently beat the simple market recipe over the long run. And that last point, it leads us directly to the next one, cost. It's pretty simple, really. With a mutual fund, you are paying for that star manager's salary, their research team, all of that active trading. It adds up. With a passive ETF, you're basically just paying for a computer program to follow a list of rules. It is way cheaper. And what about just getting in the door? How much cash do you need to get started? A lot of mutual funds have a pretty high barrier to entry. They might say you need $1,000 or even more just to get started. But with an ETF, since it trades just like a stock, you can often start with just enough money to buy one single share. This makes them way more accessible, especially for new investors. Okay, so we've seen the facts, we've laid out the differences, but the real question is, which one is right for you? Let's use one last analogy to help you figure out which camp you're in.
Think about how you like to travel. Are you a guided tour kind of person? You want an expert to handle all the details, you want to sit back, relax, and have a professional lead the way. If that sounds like heaven to you, then the hands-off approach of a mutual fund might be a good fit. Or are you more of a DIY traveler? You want the map, but you want the freedom to explore on your own schedule. You want control, flexibility, and you want to keep costs low. If that's you, then low-cost ETFs are probably right up your alley.
But you know what? Let's take a step back for a second. Because for all their differences, the way they're managed, how they trade, what they cost, at their core, they're both trying to do the same incredibly important thing for you.
And that one big goal, it's diversification. That's the whole point of the fruit basket, right? Whether you pick a mutual fund or an ETF, you are spreading your money across dozens or even hundreds of different investments. You're not putting all your eggs in one basket. And that, right there, is one of the single smartest moves any investor can ever make. Look, at the end of the day, building wealth isn't about some secret trick or a hot stock tip. It's about patience and discipline. Wealth is almost never built overnight. It grows slowly, gradually, just like a tree from a tiny seed. So maybe the real question isn't just which basket is right for me, but rather, am I ready to plant that seed and give it the time it needs to grow?